Hi, my name is Odette Boyd, your financial professional. So today we're going to be talking about life insurance. I know it's the number one thing that people don't like to talk about, and so that's why we're here to explain to you all the different types. So the first first of all, there is cost of insurance, right? And as you age, right, it goes up. So this is the cost of insurance. And let me share with you, because before it used to be that life insurance, the number one thing that people think about when they hear life insurance is death. But did you know that life insurance now is also about the living benefits? So I'm going to share with you how it started. So the very first one that came out, it's called term. So a lot of you are familiar with that. So term, just like the word itself, it terminates, it ends. And there's a contract. So you either buy a 10-year, 15-year, 20-year, 25-year, and 30 years is the longest. So after 30 years, it's gone. So this one is good just for protection. So maybe you have family and you have children that you want to protect while they're growing up, and that's what this is used for. But nowadays, term insurance have what it's called living benefits. So if you're going to buy a term anyway, you might as well buy something that's got living benefits. And what does it mean? So within this term, if something happened to you, right, chronic, meaning you cannot perform 2 out of 6 daily activities, and critical, like you have something critical happen to you, liver transplant, heart stroke, or terminal, if any of these things happen to you, you can then access your life insurance money, your death benefit, while you're still alive. So that's a good one. And then the second one that came out, it's called whole life. So just like the word itself, you paid for your whole life, but the fixed amount of premium that you're paying on it has a cash value. So you pay a fixed amount of premium every single month. Part of that premium goes to the cost of insurance because it costs money. But at the same time, part of your money is being invested inside, making 2 to 4%. So that's good. And you can later turn around, when you're older and you don't need life insurance anymore, you can withdraw the cash value. And when you do that, there's no more life insurance, or you can pay for it for the rest of your life. And when you die, unfortunately, we all die, then the beneficiary will get the life insurance policy. And the third one that came out, it's called universal life. So with universal life, same thing, there is a cash value, but now it's flexible. What does it mean? You can pay the minimum premium, so that way it can pay for the cost of insurance, and whatever extra you put goes into the cash value, making 4 to 6%. So that's good. And you can also accumulate cash value. As you accumulate it, you can withdraw money from your cash value, maybe skip a payment if you have enough to pay for your cost of insurance, but at the same time, you still have the life insurance side of it. And then in the 90s, stock market became popular. So the insurance company also upgraded their product, and they came out with what is called variable. So with variable, it's great, right? There's a cash value. It's great because you can grow. In fact, you can go unlimited. But at the same time, you can also lose, including principal, if something happened to the market, because this one is tied into the stock market. So this one is risky. Now, this is the latest life insurance now, and they all have different purpose. So the latest life insurance is called an IUL, Index Universal Life. What IUL does is there's cash value. The premium is flexible, so you can pay the minimum, pay the maximum, and whatever you pay, grow interest. And the way they pay interest is based on this global indices or indexes. So they look at the performance. They don't invest your money there, but they just look at these indexes and see how they're doing. And that's how you're going to figure out how much money you made in your cash value. So they look at the S&P 500 for United States, so the big Fortune 500. And they look at the Euro stocks for Europe. So they look at the Euro stocks 50. And they also look at the Hang Seng. So Hang Seng for Hong Kong, they look at those 3 indices, and that's how they base the interest that they give you on your IUL. So for example, if they make, say, 20%, well, you don't make 20% on your cash value, unfortunately, but they give you a cap, and this is the highest you can make on your IUL. With this one particular company, 15%. That's huge. Nobody I only know one company that gives 15%. And so what if they're negative? Because it happened. It happened, in 2008. It happened in 2000, I believe, 2 and 3. And if this happens, right, maybe they're minus 20%. If this happens, well, first of all, you keep the money that you have because every gains that you have, it's locked in. And the company, even at a negative, lets you grow. And this is your floor. This is the lowest you can make, is 0.75% interest. That is huge. And for somebody who invested their money in the stock market and lost money, they lost a lot of money, and it takes time for them to rebuild their investment. So with this, you don't lose whatever you already built. Like I said, it locks in. So if the index is going like this, because it does, it goes up and down and we don't know, it's negative, well, in your IUL, you make 0.75, right? 0.75. And it goes up, you can make up to 15%. And it goes down again, you make 0.75. So for you, you keep going up even though the market is going up and down. And you have to ask yourself, wherever it is you're putting your money, I call this the 4 cornerstone of a strong financial foundation. So wherever you're putting your money, you have to put it to the final test. Does it pass all 4? So this is the 4 cornerstone of a strong financial foundation. You have to ask yourself, where am I putting my money? Is there growth? Does it have safety, right? Or does it have tax advantage? Meaning, when it's time for you to access your money, do you have to pay tax? No tax, right? If it's legal, so you get tax advantage and also protection. Does it have the proper protection to protect not only your family, but for yourself in case you get disabled, in case you can no longer work? So with this, we say it passed all 4 because growth, hey, you can grow up to 15%. Safety, well, we already know once you gain that interest, it locks in, you don't lose it. But instead, your safety is at 0.75. And at the same time, once you accumulate cash value and it's time for you to access your money, you can access this up to 90% tax-free. Yes, you heard me right, tax-free, up to 90%. And at the same time, protection if something happened to you. Not only does your family get the death benefit, right? But also the cash value if you set it up that way. They get everything, and all this is tax-free because of this IRC 7702. It's just an internal revenue code that was put in life insurance that makes it tax-free. So also now approved in California, you can add what it's called long-term care. So you can add a rider, and for a lot of times, the difference, because if you buy a standalone, first of all, it's really expensive. If you don't use it, you lose it. But by adding a long-term care rider, paying between $10, $15, $20, you can now, if you need it, access 2% per month of your death benefit. So say, for example, you have $500,000 and you need long-term care, hey, you can access 2% of that $500,000, and that's about $10,000 a month, and you can have the care in any 50 states. So if I were you, I would choose Hawaii because you could be anywhere. So I think that's it, and that wraps it up. So if you have any question, I mean, I showed you everything, and like I said, they all have different purpose. So you got to find out if it's suitable, if it's affordable for you, and then hopefully when there is a need, you'll think of me and you'll think of my associate here. And again, we thank you for listening, and I'm Odette, your financial professional.